Welcome to the Microcap Brief. Our mission today, well, it's basically forensic accounting. We want to get past the headlines, spot those distress signals companies send out before everything goes wrong.
Yeah, think about Gold's Gym, J.C. Penney, Neiman Marcus.
Exactly. Huge names. They all sent up flares before they collapsed.
And that's the key thing for you, the listener, to grasp. These failures, they aren't bolts from the blue. They're almost always signposted.
Right. Like coded messages hidden in their financial filings.
Precisely. And we're going to crack that code today. We've boiled it down to, really, the three most critical signs. The ones that basically scream a stock is heading towards zero.
Okay, let's jump in. The first corporate killer feels obvious, but maybe hard to escape. Debt, just choking on debt.
Absolutely. It's like a financial tumor growing slowly. We use a couple of key metrics. First, debt to EBITDA.
Okay.
If a company's total debt is, say, 4 or 5 times its annual earnings before interest, taxes, depreciation, and amortization, that's the danger zone.
4 or 5 times. Got it.
Yeah.
And the second?
Interest coverage. Simple question. Are they actually earning enough profit just to pay the interest on their loans? Never mind paying back the principal or investing. Look at Toys R Us. They had, a $5 billion debt load? Forced them to pay $400 million a year just in interest.
Wow, $400 million? That's cash that should have gone into competing with Amazon, right? And improving stores.
Exactly. The debt literally starved the business. It couldn't adapt.
And that debt payment, it's a guaranteed outflow. Doesn't care if sales are up or down, which I guess leads right into the second signal. The cash is just disappearing.
You nailed it. Look, profit is often an opinion, depends on accounting rules, but cash is a fact.
Okay.
So we zero in on operating cash flow. The actual cash coming in or going out from the core business, is it consistently falling? Or worse, is it negative year after year?
Right, negative cash flow. But what about, say, a tech startup? They often burn cash for growth.
That's different. It's about scale and trajectory. WeWork, for example, valued at $47 billion at one point.
Insane valuation.
But their negative cash flow hit $2 billion a year. That wasn't just growth spending. That was proof the fundamental business model, the core idea was just broken. It couldn't generate cash.
So unsustainable burn. Okay, that makes sense. Killer number 3 then? This one feels more intuitive. The captain's abandoning ship. Insider selling.
Yeah, but it needs that detective work we mentioned. We're talking about heavy selling on the open market by the C-suite, the CEO, CFO, the top brass.
The people who really know what's going on inside.
Exactly. But here's the crucial detail. It's not just that they sold shares. It's how and when. You got to look for these things called 10b5-1 trading plans.
Ah, yes, the pre-scheduled trading plans.
Yeah.
Executives use those to say, oh, this sale was planned ages ago, nothing to see here.
Right. But the tell is when that plan was established. Was it set up just 1 month, maybe even just a few weeks, before the executives started selling big chunks of stock?
That timing is suspicious, like the Silicon Valley Bank example.
Perfect example. CEO Greg Becker sold, $3.6 million in stock using a 10b5-1 plan that was put in place just weeks before the bank imploded in 2023.
So it goes from looking like routine portfolio management to, rats fleeing a sinking ship before anyone else sees the water coming in.
It's a flashing red light, a really final signal. Now, when you see those three things together, high debt, disappearing cash, insiders heading for the exits, that's a 5-alarm fire.
Okay. Definitely cause for concern. But you mentioned something even more guaranteed to wipe out shareholders, the death spiral.
Yeah, that's actively terrifying, as you put it. It's a specific kind of predatory financing built on toxic convertible debt.
Toxic convertible debt. Okay, what's the mechanism?
The fatal flaw, the real trap, is that the conversion price, the price at which the lender can convert their debt into stock, isn't fixed, it's floating.
Floating? What does that mean?
It means it's set at a variable discount to the lowest market price of the stock during a certain period.
Wait, lowest price. So the lender converts their debt into shares at a discount.
Then they immediately sell those shares on the open market, which of course
drives the stock price down.
Exactly. And because the price is now lower, the next time they convert debt, the conversion price is reset even lower. They get even more shares for the same amount of debt.
So the lender is actually incentivized to hammer the stock price. That sounds malicious. It's a downward vortex, catastrophic dilution for everyone else.
It's a deliberate trap, designed purely to enrich the lender at the expense of common shareholders. Your actionable tip here: hunt through the 8K filings that announce these financing deals. Look for the terrifying phrases: floating conversion price, variable conversion rate, or the absolute worst, Floorless.
Floorless means there's no bottom limit to how low that conversion price can go.
Precisely. See those words? Run. Your analysis is done. It's game over for common stock.
Okay, wow. So knowing all these traps, we need a clear defense, a go-no-go signal right at the start. What's the first step in your 5-step forensic framework?
It's the survival check. Simple and brutal. Your very first defense is to check the auditor's opinion in the latest 10K, the annual report.
What are we looking for?
The killer phrase, going concern. If the independent auditor states they have substantial doubt about the company's ability to continue as a going concern, you stop right there. Analysis terminated. Don't pass. Go.
That's a huge red flag from the auditors themselves. Okay, but what if they don't have that warning? If they pass that initial check?
Then you calculate their cash runway. How long can the company actually survive on the cash it has and generates?
Right, the runway. How do we calculate that precisely? We start with cash flow from operations.
Yes, from the cash flow statement. But then you absolutely must subtract capital expenditures, or CapEx.
Why subtract CapEx? Isn't that money for growth, for investing?
Some might be, but a lot of it is just basic maintenance. Keeping the lights on, replacing worn-out machines, essential software upgrades. It's not optional if you want the business to be, exist next year.
Oh, okay. It's the cost of staying in business.
Exactly. So operating cash flow minus CapEx, which you find in the cash flow from investing section, that gives you the company's true cash burn rate, maybe per quarter or per month. A healthy company, one you'd feel comfortable with, needs at least 12, ideally 18 months of runway based on that burn rate.
12 to 18 months. That's the buffer zone. The core lesson here seems to be the companies that fail. They almost always tell us first, your job as an investor is to be that detective, listen to the numbers, not just the story.
Precisely. And so here's a piece of homework for you. Go find the latest 10Q filing. That's the quarterly report for a stock you actually own. Find the cash flow statement.
Okay.
Calculate its net cash burn for that quarter using that method. Operating cash flow minus CapEx. Then look at the balance sheet. How much cash do they have right now? Divide the cash by the quarterly burn. How many quarters or months of survival does it actually have left if things don't get better?
That's a very actionable, maybe slightly scary piece of homework. Thank you for that insight. And thank you for tuning in to the Microcap Brief.